What's going on, Gems? Today I want to talk about why is a positive risk to reward setup so important in trading. Now I've got some exciting news for you guys at the end of the video, so make sure to stick around. Okay, so jumping right into the charts, let's back up a little bit and talk about what even is a risk reward ratio, or RRR. This is where your profit potential area is actually greater than your loss potential area. So if you're trading with a stop loss and a take profit, this can easily be seen on a chart. Now, if you're not familiar with what a take profit or stop loss is, I will link my previous video above so you can go ahead and check that out. So a risk to reward ratio is basically just the ratio of what you could potentially lose, the amount that you're risking, and then to the amount that you can potentially win, or your take profit amount. So, we're over here on the Aussie dollar on TradingView. Let's just say we come over here and we've selected our long position tool. And let's say we're getting into a trade over here. We've got a stop loss of 20 pips and a take profit of 40 pips, right? So you can see where this green area meets this red area is actually where you would have entered at this black line in the middle here. Would have entered here, comes down close to stop, but ends up coming up here and taking profit right over here. So what this means in a risk to reward ratio is that you're risking down here 20 pips for your potential to win up here for your full take profit at 40 pips. So risking 20 to win 40 is a 2-to-1 risk to reward ratio. Now the reason this is so beneficial and why it makes so much sense is because what you can do is you can actually still break even or potentially make money with positive risk to reward ratio setups, even if you're not winning all of your trades. Now let me show you exactly how this works. So say we have two identical trades here. We've already identified that when you're risking 20 pips and to win 40 pips, you have a positive risk to reward ratio of 2-to-1. Or 1-to-2, depending on, it doesn't matter however you want to say it. Now, if we have two separate trades here, denominated by this long position tool, what we have is, let's say you lose the first trade. You're risking 20 here to win 40. You lose the first trade, right? So we'll take this take profit down. Now all you have is the 20 pips of which you lost. And then here on your second trade, you have the same identical setup. Now what happens if you win the first, if you lose the first trade and then you win the second trade? Well, you've lost. So you have this red area, this 20 pips. You lose. So if we scoot this up over here side by side so you can see, try to make that better. There we go. What you can see is that you lost this first trade. You then won the second trade. Well, what do you have after you win the second trade? Well, you have everything in the green. You have this 40 pip gain. So what you have here on this trade is you're actually making up for this area right here. So in your second trade, you're recovering the 20 pips that you lost in the previous trade, as well as you are gaining this next 20 pips right here. So as you can see that here with these lines, it's a little ugly, scoot that over a bit. What you can see here is that if you're taking two identical trades, both with a 2-to-1 risk to reward ratio setup, you can lose the first trade, and if you win the second trade, not only do you recover what you lost from the previous trade, but you gain up here this 20 pips. So you're coming out net positive. Now what happens if you were to do that? If you were to have the same setup, let's take these away, same setup, but instead you're trading 3 separate times. So let's add another trade here. So you're trading 3 separate times with a 2-to-1 risk to reward ratio set up the entire time, and then let's say on the second one you also lose. So what do you have here? Well, you have this first one, which is a loss, the second one, which is a loss, so 20 pips and 20 pips is 40 pips is a loss, and then this third trade. So if I can line this up a little bit better so it's visual, what you have, get this down a little bit. Oops. So what you have here is 20 pips and 20 pips, which is 40 pips in 2 separate trades, is a 40 pip loss, right? And then on this third trade, same thing, 2-to-1 risk reward ratio setup, what do you have? Well, you actually gain, you break even on this one, right? So if you were to lose these first two trades, and then on your third trade you win, well, you're getting this whole take profit amount that is actually equaling the two losses previously. So even if your win ratio is negative, if it's a small win ratio, so you're only winning 1 out of 3 trades, a 33% win ratio, you're actually net even. So you can break even, you can keep your head above water even if you're not winning all the time, or even if you don't have a high win ratio. Now, using the same methodology, what if we increase this take profit amount to 60? Well, what do we have now? We're risking 20 still, like before, risking 20 before to win 60. So we have over here, as you can see, risk reward ratio 2.91. Well, it should be 3. Let's just say it's 3. And then what you have here is you can lose 2 trades in a row, and on your third one, if you win, you're positive. Look at that. Right here. In this area right here, you're positive 20 pips. So look at that. You can lose twice in a row and win your third trade, and you're positive. You're above net even now. And that's because you're taking a setup that has a 3-to-1 risk to reward ratio. Another really interesting thing to note about using positive risk to reward ratio setups is that, let's say we have 2 trades here, right? So we're going to delete these. So we have 2 trades side by side. Okay? And on one trade, we're going to risk 30 pips. Right? So our risk to reward ratio, 30 pips to gain 60, is now 2. On this one, we're going to go ahead and drop this down to 10. Okay, so that's 10. So we have essentially a 6-to-1 risk to reward ratio set up here on the left. Now, if you're using the percentage of account risk method, having a very small or tight stop loss in relation to your take profit amount is going to mean that you can enter a higher lot size and still risk your predetermined amount, whether that be the 1% or 2%. By entering a higher lot size, your profits increase dramatically when the trade ends up going in your direction. So answer me this: if I have a trade with 10 pips as a stop loss and a trade with 30 pips as a stop loss, and I want to risk 1% on both, on which setup am I entering a higher position size? Am I entering a higher lot size? If you answered the trade on the left, the 6-to-1, you'd be correct. And the reason that is because you have such a tight stop loss, you're not allowing the market to move against you very much, and in which case you can risk a lot more, because you're saying, look, I'm going to risk all of what I can to equal 1% just in this small 10 pip zone. Over here with the 30 pips, you're saying, well, I'm actually going to allow the market to move a whole 30 pips in my direction before taking me out. So in which case, if I'm risking 1%, I'm going to need to risk a smaller position size, say, 0.3 lots on this one to risk 1%, and I might be risking a full lot on this trade over here on the left. Now what that means is, obviously, if I'm risking a full lot here, once the market moves in my direction, I'm going to be increasing my profits dramatically. I'm going to have an entire full lot that I'm trading in the market that, once the pips are increasing in my direction, is just going to be maximizing. It's going to be, increasing my profit even more. Now, when I'm over here on this side, I've only risked, 0.3 lots, and in which case, when the market starts to move in my direction, yes, I'm still going to be making money, but it's not going to be as much because I don't have as high of a position size on this trade. Last thing that I want to illuminate here, guys, for you is a really cool thing about a trading view and using these tools and the percentage of risk per trade method is that I can actually see exactly how much I stand to lose and how much I stand to win, if the trade goes my way. What I mean by that is that, let's go back to this example of 20 pips and 40 pips as a take profit. Well, if I'm risking 1% here, this is a 2-to-1 risk to reward ratio. If I'm risking 1% here, my gain, because it's a 2-to-1, my gain is actually a 2% on account. Risking 1% on account to gain 2% on account. That's that 1% risk times the 2 in the 2-to-1 risk to reward ratio setup. Now, if I have this and I'm increasing it to, we'll go up here to 60 pips, so we have that 3-to-1 ratio we just talked about. Now if I'm risking 1% here, I'm actually going to gain 3% on account. Now if let's say I were to risk 2%, this stop loss, I'm risking 2% here. Then if I still have this 3 to 1 risk to reward ratio setup, how much am I making now? If you answered 6%, you'd be correct. So now what happens if I risk 2%? Well, I have a 3 to 1 risk to reward ratio setup, and now instead of 1%, I'm risking 2%, so I multiply that 2% risk times that 3 in the risk to reward ratio setup, and I actually would be gaining 6% on account in this trade. So as you can see, that works really nicely. You're able to kind of do those quick calculations, and you can see easily that with those higher risk to reward ratio setups, your potential for profit is there. And it really makes a lot of sense, especially if your win ratio isn't that high. Maybe you're just starting out. Utilizing these high risk to reward ratio setups is really important. Now guys, there's absolutely nothing wrong with taking small risk to reward ratio setups like a 1-to-1 or a 2-to-1, especially if you're learning, you're just starting out, maybe you're on a demo account, just trying to build that confidence. Nothing wrong with that. But I will say that once you start to get better and more confident in your abilities and you want to start maximizing those profits, you're going to want to be looking for those setups that are closer to a 3-to-1, 5-to-1, maybe even a 10-to-1. Sometimes you end up getting really lucky and having high risk to reward ratio setups. Now we actually just sent out a recent trade to our VVS Academy members that was the highest risk to reward ratio setup we've had in a long time. It was an 87-to-1 RRR. Now that's just crazy. I know some of you guys have been asking about the full course, if there's going to be any promotions or discounts coming up, and I'm excited to announce that yes, we will be having some discounts coming up soon. So make sure to stay tuned for that, guys. Go ahead and follow us on our Instagram page so you can stay up to date with our deals and promotions, as well as if you haven't already, go ahead and join that free Facebook group. That's where we're going to be helping people out and teaching some Forex education completely for free. I will make sure to drop all the links to that below so you can go ahead and check us out. Thank you so much for watching, guys. Good luck trading out there.